Good morning. Investor checklist: how to tell if a property is overpriced. In competitive markets like Houston, Katy, and Fulshire, investors often ask the same question before making an offer. Is this property fairly priced, or am I about to overpay? Now, overpaying doesn't always mean it's a bad deal on day one. It often shows up later through weaker cash flow, refinancing challenges, or limited exit options. And this investor checklist walks you through key indicators that signal when a commercial property may be overpriced and how experienced investors can protect themselves. Number one is cap rate versus market reality. So start by comparing the in place cap rate to comparable assets in the same submarket. And some of the red flags you might notice are that cap rates materially lower than market averages without strong rent growth, or pro forma cap rates that rely on aggressive assumptions, or the pricing is justified solely by the future upside versus its current as in place financials. So if the property's current income doesn't support the price, you're paying for hope, not for performance. Number two is rent levels are above market. Above market rents can look attractive on paper, but they could often signal risk. So it might be worthwhile to check some of these resources: recent leases versus the market comps, what tenant concessions or free rent periods look like, and also renewal probabilities at their current rent levels compared to the market. And if rents are already stretched, future growth may be limited and vacancy risk increases. Number three is expense ratios that look too good. Understanding operating expenses are one of the most common ways deals get overpriced. So here's some items you could look for: missing management fees, deferred maintenance in the property, insurance or tax expenses below current market levels. So it's always a good idea to normalize expenses to market standards before you underwrite the deal. And make sure you factor in vacancy. Four is weak debt coverage at market rates. So a deal that only works with aggressive financing is often overpriced. And here are some key warning signs that you could look for and spot: a DSCR below a lender minimum at today's rates. So that means they're not trading in line with current cap rates. Reliance on interest only periods to make the numbers work, or cash out assumptions that exceed conservative leverage levels. And strong deals survive conservative underwriting is the bigger concept. Number five is exit value assumptions that stretch the reality of the situation. So ask yourself, what cap rate will buyers demand in 5 to 10 years? Is the exit cap lower than today's entry cap? Is value growth dependent on perfect execution? And if the exit only works in a best case scenario, pricing may already be too high to make a deal work under those assumptions. Number six, seller motivation or lack thereof. Not all sellers are motivated, and that really matters. And here are some signs pricing might be inflated: long time on market with minimal price movement or adjustments. If they have the phrase testing the market language in there, or on Zillow, they have the make me move concept. But basically, that tells you there's no urgency tied to the refinancing partnership issues or 1031 timing. And motivation often creates pricing flexibility. Number seven is replacement cost versus purchase price. Compare the purchase price to the replacement cost for the property. And if you're playing close to or above what it would cost to build a brand new unit, the asset must offer some location or income advantages to compensate. And deferred maintenance becomes more critical. As well, the downside risk increases in a correction. Replacement cost acts as a pricing gravity point over time. And here's the final thought for the day: that discipline beats emotion. And overpriced properties don't always look bad. They often look almost right. And experienced investors will rely on these things. So more conservative assumptions, market supported comps, and financing stress tests, but also a clear exit strategy. And if a deal requires everything to go perfectly, it's probably priced too aggressively, is the bigger takeaway. But that is it for the day. Please visit my website, HoustonRealEstateBrokerage.com, to figure out how to get a hold of me. Look forward to hearing from you. Have a good day.